Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena and I would like to talk about the really fun topic of payroll tax. And what we wanted to do is provide a bit of an introduction to payroll tax. What is it? When does a business need to pay it? How is it levied? How does it all work? All those sorts of things. So payroll tax was introduced about coming on 80 to 100 years ago. So it's been around for a long period of time. And the important thing to note is it is a substantial amount of a state's revenue. About 25 to 30% of a state's tax revenue, it comes from payroll tax. Of course, another big share is property-related taxes like land tax and stamp duty. That's a larger proportion than payroll tax, but payroll tax is a big proportion. So I think that's important because businesses need to understand that it's probably not going anywhere, and there's it's tempting for state governments to tax more or generate more revenue from payroll tax rather than less because it is such a big portion of it. What do we think about payroll tax, Mena? Do we think it's a good tax?
I don't believe so. I really think it discourages businesses from expanding their workforce. You know, they'll look for alternatives because it can be quite expensive, especially as your business grows and your payroll sort of increases with it. So, you know, a lot of businesses will look for alternatives, whether it be, you know, automating systems in-house, which might not be such a bad thing. We do encourage that regardless, but, you know, could go from other things such as outsourcing. So they're basically taking their business overseas. Now, you know, from a federal and state perspective, do we really want that? Do we want unemployment rates to go up and so forth? So from my perspective, at a macro level, I don't necessarily agree with the tax, but I guess it's a necessary evil since, you know, it is such a big revenue for the state governments.
I think Australia does need to improve its productivity, as I've said before on this podcast, and that means producing more per every hour of labour input. But payroll tax isn't necessarily a way you're going to achieve that because obviously one of the government's key roles is to build a thriving economy, because a thriving economy not only benefits its residents, but also, you know, it just grows the tax base. So it's good for the government as well. You're growing that pie. What payroll tax does is disincentivize a growing business to employ more staff, and it just doesn't make sense. I think it should be kind of the reverse, if you like. There should be tax incentives if you do have a growing workforce versus a declining workforce. Anyway, let's talk how it's levied. So it's a state-based tax. It's going to be different in each state. And what happens is you must report your salaries. I mean, Mena will talk us through, you know, what's included in, let's call it salaries or remuneration. You report that to the state government at the end of each financial year, notwithstanding they're going to get a data feed from the federal government through single touch payroll, through the payroll stuff that you lodge. And they will then levy a tax if your remuneration expense is above a threshold. And so in most states, that threshold is between $1.2 to $2 million. So New South Wales is 1.2, Queensland 1.3, South Australia 1.5 million, WA is $1 million, ACT is actually 2 million. So they're the thresholds. Now, Victoria is the outlier. For the financial year just ended, the 24 financial year, the threshold was only 700,000, so about 50%, of the other government's thresholds. Thankfully for 25, this current financial year, the threshold is 900,000, and the following 26 financial year it increased to $1 million. So at least Victoria is slowly bringing up their threshold to something more in line with other states, but certainly at the moment it's not in line. And how it works is that if you exceed the threshold, you are taxed on the amount that exceeds that threshold. So for example, in Victoria, the threshold this year is 900,000. If your remuneration bill is, say, $1 million, then you've exceeded the threshold by 100,000. The payroll tax rate is 5%, which means that you'll pay $5,000 in payroll tax in that year. And the percentage rates are around tend to range between 5 and 5.5%. There's not a big difference there. Queensland's a little bit lower at 4.75 and ACT is a little bit higher at 6.85, although it has a much higher threshold. So that's how it works, and it's not a marginal system. You're either, once you're over the threshold, you pay the same flat rate of payroll tax regardless.
So what's included in terms of payroll? So these thresholds, they include obviously your base salaries, commissions, bonuses. They include your SG contribution, so your super, as well as any reportable contributions. Director fees, these are ones that are commonly missed actually. Fringe benefits, share options, and employee termination payments. So the cumulative total of that, if they exceed that threshold, then you're obviously liable for payroll tax. Now, genuine contractors don't necessarily attract payroll tax, and this is a bit of a grey area. We're hearing of case studies in New South Wales and Victoria of, the State Revenue Office going after medicos, for example. Now, yes, they've come out with certain amnesties for GPs, but a lot of medicos and allied health professionals need to really look into the business operations to see whether their contractors are actually genuine and fall outside the scope of payroll tax. Now, payroll tax itself, the expense is tax deductible, so that's the only positive, I guess. So the net cost is anywhere between 70 to 75% of what you're actually paying, whether you're on a 30% or 25% tax rate.
There's some grouping provisions. Now, again, these are state-based taxes, right? So it's important to understand there's going to be idiosyncrasies between the different states. But just generally, if there's common control, so the same shareholders, for instance, or same unit holders if it's a unit trust, or common ownership, so, that a family trust owns a couple of different businesses, for instance. And when they talk about control, it's more than 50%. So 50% is in control, but more than 50% is control. It is, or there's interdependence between two businesses. So that's where you might have a service entity and a trading entity, for example, but the state governments will seek to group those entities. So this is a really important thing to consider in terms of if you do have different business lines or business units and they do have significant payroll expenses in them, it's something that you might want to consider, if it's possible, in your structuring, to consider the payroll tax implications of that and trying to benefit from, I guess, as many tax-free thresholds as possible. Again, it's a pretty complex part of the law and complex part of the structuring, too difficult to kind of explain in a podcast environment, but just realise that if you do have common ownership, common control, it's very possible that the State Revenue Office, or whatever it's called in your particular state, will seek to group the payroll liabilities of all those entities and include it under one threshold.
Now, there's some exemptions and concessions in place, and these are, since being a state-based tax, very sort of state-dependent, so you'll need to see if any of these really apply to you. But most states provide a sort of regional employment concession, along with sort of apprentices and trainee salaries exempt in most states. There's certain concessions available for primary producers, your farmers and agriculture and so forth. NFP organisations or not-for-profit organisations and charities and so forth, there's generally exemptions in those industries. Paid parental leave is usually one that's not included as your total remuneration, and certain R&D entities, your research and development entities, are sometimes exempt or can get a concession for payroll tax.
So what can you do around, what are the common sort of planning tips, I guess, around payroll tax? And Mena, I would like to sort of talk to those. So the obvious one is that if you're paying yourself a salary from your business, which a lot of business owners do, and you're getting close to the threshold in your particular state, stop paying yourself a salary. I mean, you don't want to be in a situation where your salary is the one that attracts the payroll tax, because it's easily avoidable if possible. I mean, it depends on your business structure and the reasons for wanting to pay a salary, but if you're able to take a dividend instead or a distribution, at least that helps you get under the threshold.
Consider your ownership structures. So obviously, as Stuart mentioned before, control is one of the main components that payroll or state revenue officers look at when it comes to payroll tax. So, if it's owned in a 50-50 structure, then, and you've got other businesses, then that business won't necessarily be included in your payroll tax threshold. Now, obviously, if you're related, so if it's a husband and wife, then you're grouped. But if you're two independent entities or two independent individuals, then you're not necessarily grouped. So consider how you should structure your business so you don't attract a payroll tax.
Timing of bonuses or variable remuneration can be a consideration as well. So if you're getting towards the end of the financial year and you usually pay bonuses in June and you're close to the threshold, well, I mean, if it's acceptable to your staff and you're able to get agreement, then maybe paying those bonuses in July will be a better outcome. Of course, if you expect to pay the same level of bonuses each financial year, all you're really doing is kicking the can down the road because you only get that opportunity kind of once. So you might want to consider that as well. But I guess if we're close to the threshold and we've got some variable remuneration, that might be something that we can do to avoid it.
And the last thing is to basically just provision for it. You know, you can only kick the can down the road for so long. So it's really important to just know when it's going to come. Make sure you lodge the statement on time because the State Revenue Office actually applies some ridiculous penalties on the interest for late lodgements and payments. And just provision for it, like I mentioned, and make sure it's included as a cost in your pricing system because if it's going to come, you need to make sure that you're still profitable and can account for those labour costs.
So there you go, payroll tax, an insidious tax that we think actually discourages economic growth rather than promotes it. But because the states are very reliant on that revenue source, it's probably never going to go anywhere. It's never going to change. So it's just one of those additional expenses that business owners need to navigate. And hopefully that overview of payroll tax at least gives you an idea of what it is, when you might end up having to pay for it and how much that might be. Okay, until next week, bye for now.